Return on equity. It is the net profit divided by the net worth. Net profit is used in the numerator because it is the earnings which is retained in the balance sheet of a company for returning to the shareholders at some point in time in the future in the form of dividends or for reinvestment in the business. The net worth is used in the denominator because net worth comprises of the paid up equity capital and the retained earnings and the other reserves and surpluses which all belongs to the equity shareholders. And any goodwill which is present on the asset side of the balance sheet should be actually subtracted from the net worth in order to get the tangible net worth, and that tangible net worth in turn should be used in the denominator. Presence of any non-current investments and any current investments which are substantial would actually degrade the return on equity, as the return on investment is usually lesser than the return on the equity or the tangible net worth. ROI is nothing but the growth rate of equity or the net worth. That is, the net worth grows as much as the earnings which is retained after dividends. Therefore, in an ideal scenario, the share price of the company should be the same as the book value. And if the dividend is issued, then the share price should decrease by that much, as the net worth decreases by the amount of dividend. However, things doesn't work that way. Stock market is forward looking, so mostly the price of share moves well ahead of the book value. ROE is the inverse of PE, and the price to book value is equal to 1 and the dividend is 0. And ROE is kind of a proxy for quality of the management. So if ROE is higher, that means the company is managed well. So ROE is greater than 10. ROE which is greater than 10 is usually good. However, it also depends on the industry or the sector to which the company belongs to. For example, there are some asset heavy industries such as banking, etc., where the ROE is usually low. However, there are asset light businesses which have a high ROE. Also, there are working capital intensive businesses which have a low ROE too. Cash rich companies usually have a high return on equity because they distribute everything they earn in the form of dividends and they do not retain anything in the books. And this is the opposite to the cash poor company, because the cash poor company they don't have any cash to return to distribute as dividends to the equity shareholders. Therefore, they retain the earnings whatever they receive, and because of that, the net worth increases and the return on equity decreases. Also, companies that have a high dividend payout, which gives a high dividend payout, usually have a higher ROE because they retain less earnings in the equity and rather distribute more cash as dividends.